Hello everyone and welcome back to these sessions on financial reporting, and here we are continuing with the financial statement analysis topic. And in the previous class we have just covered the first case study. In today's class we are going to take up the case studies ahead, and we will obviously begin with case study 2. So I want you all to please pay attention over here when we are talking about the second case study. Let us first read this whole thing. I'll just enhance the screen size. It says Pluto Limited has purchased a manufacturing plant for rupees 6 lakhs on April 1, 2021. The useful life of the plant is 10 years. On 30th September 2023, Pluto temporarily stops using the manufacturing plant because demand has declined. However, the plant is maintained in a workable condition and will be used in future when demand picks up. The accountant of Pluto Limited decided to treat the plant as held for sale until the demand picks up and accordingly measures the plant at lower of carrying amount and fair value less cost to sell. Also, the accountant has stopped charging the depreciation for the rest of the period considering the plant as held for sale. The fair value less cost to sell on that date was 4 lakhs, that is on 31st March, 30th September 2023 and 31st March 2024. It was 4 lakhs and 3.5 lakhs respectively. And this is the carrying amount as per their calculation. Look at this purchase price, and life being 10 years, you divide 6 lakhs by 10 years. And 2.5 years have been passed by up to that date, so accumulated depreciation is 1,50,000. This is the carrying amount, and fair value less cost to sell on the date when they have classified it as held for sale, it is 4 lakhs. Lower of these two values they have considered as 4 lakhs. Now this is what they have done, okay. Then at the later date, because the fair value less cost to sell has come down to 3,50,000, they have valued it at 3,50,000. Analyze whether the above accounting treatment made by the accountant is in compliance with the Ind AS. If not, advise the correct treatment along with necessary workings. So guys, if you look into this whole matter, what exactly is this case targeting? This case is talking about a scenario where an asset is classified as held for sale. So first of all, which Ind ASs are coming into picture? First of all, the asset primarily is classified as property, plant and equipment, that is Ind AS 16 is getting involved. And then because the asset is being reclassified as a non-current asset held for sale, they have even put it into that reclassification category, and so the asset will be requiring the application of Ind AS 105, that is non-current assets held for sale. Now we need to look into the conditions given by Ind AS 105 for an asset to be reclassified as a non-current asset held for sale. How would you apply those conditions? And first of all, are we finding that what has been done in this case by the accountant of Pluto Limited, is it justified? Is it the appropriate thing? The answer is no, it is not appropriate. If I take you to the important lines in this case, what we have just read, look at this. The plant is maintained in a workable condition and will be used in future when demand picks up. That means as of now, just because the product that the company is manufacturing is not having demand in the market, the plant is lying idle, correct? An idle plant cannot be classified as held for sale because it is maintained in a workable condition. Neither you have abandoned the plan, nor you have actually held it for sale, because if you keep it for sale, then you should not have any intention of using it. Whereas this line clarifies something different. The plant is maintained in a workable condition and will be used in future when the demand picks up. That means again when needed, you will again start using the plant. You cannot put something as held for sale on temporary basis. If it is classified as held for sale, it has to be a permanent reclassification from your property, plant and equipment to the other category, that is non-current assets held for sale. So first of all, this reclassification made by the accountant is not appropriate, because the recovery of the plant, it should primarily be from the sale. That is one precondition, correct? You would have read that condition under Ind AS 105. See, how can you recover any assets value? Either by use or by sale. So when the use is no longer going to happen, when the entire value you are going to recover only and only through sale, then and then only you can reclassify that as a non-current asset held for sale. Otherwise it is not permissible. That means this reclassification made by the accountant is not appropriate, first of all. Second mistake what the accountant has done, accountant has stopped charging depreciation. Now obviously, because the accountant has put it into the category of non-current asset held for sale, because the asset is treated as held for sale, they have stopped charging depreciation. But primarily the major mistake is the asset should not have been classified as held for sale. It should have been continued to be kept under Ind AS 16, that is property, plant and equipment category, and depreciation should be continued to be charged. So these are the flaws that we find in that given case. And how would we go for the treatment? Let me read out the answer for you, what is suggested by ICAI study material. Look at this solution, how it goes. It says the present treatment needs to be examined in the light of provisions given in Ind AS 16, property, plant and equipment, and Ind AS 105, that is non-current assets held for sale and discontinued operations. Para 6 of Ind AS 105 states that an entity shall classify a non-current asset or a disposal group held for sale if its carrying amount will be recovered principally through a sale transaction rather than through continuing use. This is the fundamental issue which the accountant in case of Pluto Limited has ignored. Further, paragraph 7 of the same standard says, for this to be the case, the asset must be available for immediate sale in its present condition, subject to terms that are usual and customary for sales, and the sale must be highly probable. Thus, an asset cannot be classified as a non-current asset held for sale if the entity intends to sell it in a distant future. So what is the point that we can highlight over here in this case? That they have kept it open that okay, when the product demands again rises up, we will start using the asset and we will start producing the product. The plant will still be used in future. You cannot reclassify again and again from one category to another category. If you believe that your plant is lying idle, idleness of plant cannot become a condition to reclassify that as held for sale. So that was the fundamental issue. Anyway, reading it further. Now what does paragraph 8 say? For sale to be highly probable. Now this is the condition given for sale to be highly probable. So basically these conditions I need not even read for you. You know these conditions, you would have learned these conditions under Ind AS 105. So there has to be an active market for sale of such asset, and the management should have committed to a plan to sell the asset or should have initiated a program already, and there should be a program to locate a buyer and complete the plan must have been initiated. So basically if you again look into, no activities have been taken by management over here, so it is not making the sale highly probable. If the sale is not highly probable, that is again breach of another condition where you are not supposed to reclassify that as held for sale. Para 13 further says an entity shall not classify as held for sale if that is to be abandoned. This is because the carrying amount will be recovered principally through the continuing use. So if you have kept the plant idle or if you have abandoned it, either case you are not going to classify that as held for sale, because the conditions which are required for reclassification into held for sale are different conditions which we have just discussed right now. So whether it is intended to be used or abandoned, under either case you are not supposed to reclassify it under held for sale. So now the question arises, what would be the right treatment? So here depreciation should cease to accrue, correct? That is, if you are going by reclassification, depreciation should cease to be charged, and if you are continuing with the use of the asset, depreciation does not cease when the asset becomes idle or retired from its active use unless the asset is fully depreciated. This is the condition given under Ind AS 16, and what is written over here as per para 14 of Ind AS 105, an entity shall not account for non-current asset that has been temporarily taken out of the use as if it has been abandoned. So looking into all these conditions, we can confirm that the accountant of Pluto Limited has not given the right treatment, and that is what mentioned in the answer over here. The accountant of Pluto Limited has treated the plant as held for sale and measured it at fair value less cost to sell. Also, the depreciation has not been charged thereon since the date of classification as held for sale, which is not correct in accordance with Ind AS 105 and 16. So Ind AS 105 error is not that you haven't charged the depreciation. As per Ind AS 105, you have wrongly classified this under held for sale. The mistake is as per Ind AS 16 that you have stopped charging the depreciation where the asset is still likely to be used. Accordingly, manufacturing plant should neither be treated as abandoned asset or held for sale because carrying amount will be principally recovered through continuous use. Pluto Limited shall not stop charging depreciation or treat the plant as held for sale because its carrying amount will be recovered principally through the continuing use to the end of their economic life. Now the reworking, if you see what it should be done, look at this. 6 lakhs is the original cost. Accumulated depreciation, you are going to charge the depreciation for the entire year, that is up to that date till the balance sheet date. It will be complete 3 years time, not up to September only, till 31st March. If you charge the depreciation for 3 years, this will be the carrying amount, and the recoverable amount as at 31st March 2024 was 3,50,000 because fair value less cost to sell is that. So in case you want to drop this amount to 3,50,000, you need to charge impairment loss as per Ind AS 36, and you are not supposed to recognize anything else. So it will be still classified as property, plant and equipment, and the amount will be 3,50,000. That is the conclusion, and here they have given some workings for you to understand. So I am sure you are clear with this particular case. Let us move on to case study 3. Now case study 3 begins with this line. On 5th April 2022, a fire damaged a consignment of inventory at one of the Jupiter Limited's warehouse. This inventory had been manufactured prior to 31st March 2022, costing rupees 8 lakhs. The net realizable value of the inventory prior to the damage was estimated rupees 9.6 lakhs. Because of the damage caused to the consignment of the inventory, the company was required to spend additional amount of rupees 2 lakhs on repairing and repackaging of the inventory. The inventory was sold on 15th May 2022 for proceeds of rupees 9 lakhs. Now, the accountant of Jupiter Limited treats this event as an adjusting event and adjusted this event of causing the damage to inventory in its financial statement, and accordingly remeasures the inventories as follows. Cost is 8 lakhs, net realizable value they have taken as 9.6 minus 2, that is 7.6 lakhs, and lower of cost or NRV is considered as 7.6 lakhs. Analyze whether the above accounting treatment made by the accountant in regard to financial year ending 31st March 2022 is in compliance with the Ind AS. If not, advise a correct treatment along with working for the same. So first of all, the standards which are coming into picture, it is the inventory standard and the events occurring after the reporting period. Two standards are coming into picture. The point is the application made by accountant appropriate or not? Particularly if we talk about the events after the reporting date, these can be principally classified into two different categories of event: adjusting events and non-adjusting events. Now, you would have learnt it very clearly that what are adjusting events? When occurrence of the event is a further evidence to conditions or situations that were already existing at the balance sheet date or at the reporting date. At the reporting date, was there any condition of that fire? Look at the date on which the fire has occurred. It has occurred on 5th of April. Even though you would not have prepared your balance sheet by then, but it is an event that has occurred after the reporting date or after the reporting period, and at the reporting date or reporting period end, there were no indications, there were no conditions that existed about such and such losses. These conditions have arisen after the reporting period. First of all, this is clearly a non-adjusting event. So the right treatment at the balance sheet date should be strictly as per Ind AS 2. That should be the lower of cost or net realizable value should be the base of reporting the inventory. The net realizable value is clearly above the amount of cost. Now, this repackaging and all happened because of the occurrence of that event. Therefore, there was no indication of such loss that might arise in future as at the reporting date, and therefore, as at the reporting date, there is simply the application of Ind AS 2, according to which the cost of inventory being 8 lakhs, the net realizable value being 9.6 lakhs, you have to consider the lower of those two values and nothing else. Now, look at the solution given by ICAI over here. So here the standards that are coming into picture, as I said, inventory standard, that is Ind AS 2, and the standard on events after the reporting period, that is Ind AS 10. So Ind AS 2 and Ind AS 10 are coming into picture. So para 3 of Ind AS 10, it says events after the reporting period. It defines events after the reporting period are those favorable and unfavorable that occurs between the end of the reporting period and the date when financial statements are approved by the board of directors. And two types of events can be identified: those that provide evidence of conditions that existed at the end of the reporting period, and those that are indicative of conditions that arose after. So this is the fundamental point. So these are adjusting events and these are non-adjusting events. Our scenario falls in this category, correct? It falls in this category, which is the category of what? Non-adjusting event. But over here the accountant has treated this as adjusting event. That is the fundamental error. And an entity shall not adjust the amounts recognized in its financial statement to reflect a non-adjusting event after the reporting period. Net realizable value is the estimated selling price in the ordinary course of business less estimated cost of completion and estimated cost necessary to make the sale. inventory shall be measured at lower of cost or NRV as per Ind AS 2. We know that. So basically, the accountant of Jupiter Limited has remeasured the inventory after adjusting the event in its financial statement, which is not correct and not in accordance with the provision of Ind AS 2 as well as Ind AS 10. Accordingly, the event causing the damage to the inventory occurred after the reporting date as per the principles laid down under Ind AS 10 is a non-adjusting event. That was the fundamental issue, that it was a non-adjusting event, as it does not reflect conditions at the reporting date. Non-adjusting events are not considered in the financial statements but are disclosed where there is a material effect. Therefore, as per the provision of Ind AS 2 and Ind AS 10, the consignment of inventory shall be recorded in the balance sheet at lower of the cost or net realizable value as at the date, that is as at 31st March, where there was no hint of such event to be occurred, and inventories will be carried over at rupees 8 lakhs. So I don't think there could be any doubt in this particular case. This was a very simple case study. So let us now focus on the case study number 4. Let us first read this case study. Case study 4. On 1st April 2021, Sun Limited has acquired 100% shares of Earth Limited for rupees 30 lakhs. Sun Limited has 3 cash generating units A, B and C with fair value of 12 lakh, 8 lakh and 4 lakh respectively. The company recognizes goodwill of rupees 6 lakhs that relates to CGU C only. During the financial year 2022-23, the CFO of the company has a view that there is no requirement of any impairment testing for CGU since their recoverable amount is comparatively higher than the carrying amount and believes there is no indicator of impairment. Analyze whether the view adopted by CFO of Sun Limited is in compliance of the Ind AS. If not, advise the correct treatment in accordance with the relevant Ind AS. Now guys, this is again a very simple case what I find. You know one thing, when should you apply test of impairment as per Ind AS 36? 2 scenarios. Number 1, wherever there is an indication of impairment at the reporting date, if you have any indications of impairment, you are definitely supposed to carry out the test of impairment. But if you identify one thing, if there is any goodwill arising in business combination, whether it is related generally to a cash generating unit specifically or to a group of cash generating units, if there is a goodwill which is recognized in the financial statement because it has arisen due to a business combination in the past, that goodwill cannot be amortized, correct? That goodwill needs to be tested for impairment every year. Until that goodwill is existing, you need to carry out test of impairment every year. That is the problem over here, that there is no indication of impairment, that is understandable, but not because of that condition, but it is because of the existence of goodwill that you need to carry out the test of impairment on annual basis. So look at the answer given by ICAI over here. The above treatment needs to be examined in the light of provisions given in Ind AS 36 impairment of assets. Para 9 of Ind AS 36 says impairment of assets states an entity shall assess at the end of each reporting period whether there is any indication that an asset may be impaired. If any such indication exists, the entity shall estimate the recoverable amount of the asset. Paragraph 10b of the same standard, that is Ind AS 36, states that irrespective of whether there is any indication of impairment, an entity shall also test goodwill acquired in a business combination for impairment annually. Every year you need to carry out this test. Sun Limited has not tested any CGU on account of not having any indication of impairment is partially correct because A and B are not basically subject to any impairment, but it is not appropriate for CGUC. Hence, the treatment made by the company is not in accordance with Ind AS 36. Accordingly, impairment testing in respect of CGU A and B are not required since there are no indications of impairment. However, Sun Limited shall test CGUC irrespective of any indication of impairment annually, as the goodwill acquired on business combination is fully allocated to CGUC. Guys, if you look into one thing, the moment when I am discussing these case studies with you, you would find that this is very easily understandable and you can actually do it on your own. You don't need anyone's help. The only help that you need is conceptual clarity on the coverage of all Ind ASs. So what I would suggest always is, before you watch my next video on the further case studies, which will be case study 5 onwards, I would suggest you that don't start watching case studies one by one directly. I would suggest you to go through these case studies on your own and look into whether you are able to apply your process of thinking or not. So 4 case studies that I have discussed by far, it is enough guidance on how to go ahead with this. So I would suggest you all very strongly that before watching the next video, please you try to approach these given case studies. In case you are having any complication over there, you would notice that I would have already addressed that complication in the discussion. But where you are able to apply it on your own, you will just watch that case study which is recorded by me in any of the videos ahead, just as a matter of confirmation. Yes, what approach you were thinking of is fine, and supposedly you are not approaching it in the right direction or your thinking line is going little wrong, then when I am giving you that guidance in the videos ahead, you will be able to rectify yourself, which is a good thing. So instead of directly watching the video, because this is not a new concept that we are discussing, right? Instead of watching the video directly, you should actually learn how to apply your concepts first. In case guidance required, videos are there. In case you believe that you have done it on your own, you can just read the suggested answer by ICAI and it can give you a confirmation whether you have thought on the right line or not. However, I still encourage you to watch my videos ahead, because in spite of you cracking that particular case on your own, you should still watch the videos, because some angle which sometimes even ICAI doesn't mention it clearly, I would have brought it into my discussion. So I will just put an end to this particular session, and please do the needful before watching the next video. Thank you very much.